Hey everybody, David Cristello here, founder and CEO of Jetpack Workflow and host of Growing Firm Podcast. Today's guest is Mark Myers. He is the founder of Peak Profit Solutions. He calls himself the tax savings architect. And today we're going to try to unpack, a handful, 3, 4, 5, maybe we'll get more, maybe we'll get less. I don't know. Not obvious tax saving strategies that you, the firm owner, should be thinking about as you're consulting and working with your clients. As we know that the world of advisory and being proactive is red hot, and everybody's trying to understand what this is and how to do it. And we're going to unpack some of those tactics of what you should be thinking about from a tax saving perspective. But having said all that, I first want to just come to the show.
Hey, David, thank you so much. I'm really excited about today. The audience that you have is really the best audience that I could speak to. And I would say that out of the 80% of the referrals that I receive, 50% of them come from, forward-thinking tax professionals, whether they're a CPA or an enrolled agent or some firm that does accounting and all types of bookkeeping, et cetera.
I love it. Yes, we do have the best audience. That's the way I took your comment. We have the best podcast audience in the market. I love it. Well, really quick before we dig into some of these non-obvious tax saving strategies, briefly, what do you do with firms? What does that typical engagement look like? And then we'll dig into some of the tax saving strategies just to set the context.
Oh, perfect. So the way that I engage with each individual firm is really unique in that I'm not coming in with some boilerplate platform. I'm coming in very nimble and light. I have over a dozen different solutions that I've vetted over the course of the last decade. And I'm continuing to vet them that's what I do. I utilize the solutions that I've vetted as long as they're still viable. And of course, the IRS is still, there's no issues with using them. And of course, I'm always looking for more. So when I'm engaging with a firm, I'm either going to be an additional resource that they bring in for certain clients, or I'm going to be working behind the scenes with them. And they can take the lead on some of these things as well. So it really just depends on what the firm wants to do. And how efficient they want to be with me, being able to take a really heavy load off of their back if they'd like.
Got it. Awesome. Well, having said that, let's start diving into some of these tax saving strategies that should be top of mind for a lot of firm owners. But again, maybe they don't have the time to read as many really exciting documents as you've probably sorted through. What's the first one that should probably be top of mind that isn't quite obvious for a lot of firm owners?
Sure. Well, I think, and there's so many we could talk about, David. We'll jump into this one. This is fun. This is a lightweight. I call this kind of a lightweight marketing and consulting opportunity. There's about 20 different tax-free fringe benefits, and most tax professionals are aware that they're out there. The LERPs, the MERPs, the different things, the medical reimbursement plans, et cetera. They know they're out there, but they're kind of arduous with regard to how do you structure it? How do you put it into policies? How do you really integrate this? How do you make sure it's done right and it's not putting the business owner or whoever's using them at risk with regard to having to offer all these benefits to other employees? So the first thing that I always say is you don't have to work with business owners. I work with just individuals that have really high income and they're W-2 and they have no real solution outside of, hey, I've got this huge withholdings and this additional tax from my K-1s. We can work with them too, but let's just say it's a business owner and they have a little more flexibility with how they take their income. Well, if they were to structure an entity that supports their main entity, and let's just say it's a marketing consulting company, well, we can actually structure that in a really unique way in that the only individuals that would truly benefit from these fringe benefits in this marketing consulting company are the owner and their family, and maybe whoever else they'd want to bring into that little world. But the cool thing is, if this is structured correctly, there are policies that can be put in place, and there's about 20 of them that are in the code. They've been there forever, decades, some of them decades, that allow for the employees or the people working in that entity to take income, but it's not categorized as income. It's categorized as a benefit. So take money out of this corporation in the form of a benefit, meaning it's not taxable to the person receiving it. And of course, the great news is some of these benefits can be created, these dollars can be created with no expense. So there's no expense to the company, yet the dollars can be distributed to the employee as a benefit non-taxable. So we're basically creating deductions that have no cost, and we're able to get that money to the workers of the entity at no tax ramification. So like for example, when employees or people in a company work outside of business hours, there's a tax code that's been around for a really long time that basically says they can take a stipend. And it's essentially for the time that they worked outside of business hours, and it's for maybe a meal that they had, et cetera. But they supply the documentation that they supply, and what the tax code asks for is a record that they took a meal and worked outside of business hours. It doesn't require a receipt. There's nothing, so it really is just a log. So they can do this a certain number of times per year. Obviously, you don't want to go over the line. There's black and there's white and there's gray. We always stay in the black and white, not the gray. So how many times can you do this? How much should you do it for? How should you set up your policies? So these are things that when you add them up, in this type of business, sometimes you can get $70,000 to $120,000 worth of deductions that literally have no cost. And you can move that to your personal bank account at no tax event. If that makes sense. So if $100,000 was coming straight to you from your main entity, your main company, as profit, and it was taxable, then you'd pay whatever your tax bracket is. Let's just say you're in Florida and you have no state income tax, and you're at the highest bracket for that 100,000 because you have a high income. Well, that's $37,000 of tax that you have to pay on it. Well, what if that was earned by your marketing and consulting company for services that were provided to your main entity? But that same $100,000 could come out of your marketing and consulting company as a benefit because you have the policies in place that have the tax code that allow for it. And now that same $100,000 moves to you or your family as benefits, and it's not taxable. Well, that's a $37,000 tax savings on the same $100,000 coming to that individual or their family. Hopefully that makes sense.
Yeah, and you might hear some of my we'll call it lack of understanding of the tax code at large here, but you're kind of prescribing here in this case to achieve some of these fringe benefits, setting up multiple entities in which income and expenses can kind of move through, and depending on the situation, they can be distributed as a certain benefit that has tax saving advantages. Is that high level 100%. Correct? Yeah,
100%, David, because there's two levels of tax efficiency. One is I call above the line, meaning that if you're a business owner, right, you're looking at how can you get tax savings before it moves down to your 1040, right? And then there's below the line tax savings. And a lot of times people think about, well, how much can I put in my SEP? Or do I need to do a defined benefits plan or a cash balance plan or my 401k? Well, that's kind of like, you're deferring it. I always call that procrastination. You're not really saving tax. You might even be paying more tax, right? But a lot of people think, well, that's tax planning. How can I max out my qualified plan? So the above the line is like, a different entity that can support your entity. I mean, we have larger companies that we work with. Well, they can actually outsource. And the unique thing is if they outsource a component that they're doing in their business to an economic development zone, not an opportunity zone, but an economic development zone, which basically that area says if a business is started here, we're going to give you significant tax benefits for the profit that's generated in this business. So what if company A, and all the big companies do this, they've been doing this for decades, they put company B in an economic development zone and they figure out what types of activities can company B do so they can shift profit from company A to company B. And they control company B, right? They still have control over what happens over here, and they still have access to those profits. But the great news is the profits are now being earned in an economic development zone, and they might have a 4% tax and maybe no tax above and beyond that for owners that have a certain domicile or they're structured in a certain way. So the above the line planning or captive planning too, that's a whole nother concept, like people that need to increase their insurability or improve their insurability. Now they can probably self-insure as opposed to writing those checks to Chubb. So these are like for businesses, we have a lot of very powerful ways to do above the line planning. But then when it comes to below the line planning, we have some really powerful things to do that are much better than just deferring it into some type of qualified plan.
Got it. Well, I know we got a couple to go through here. Let's dive into the second one. Whether it's above the line or below the line, I'll let you pick. But what's another non-obvious one that should be on people's minds?
Okay, so this one's great because it's super simple. And this is below the line and it applies to anyone that has a high tax bill. whether they're W-2, 1099, they own a small business, they own a medium-sized business, doesn't matter. And it can be income source from passive, from real estate that they own, that they're paying regular income tax on. So charitable giving has been around forever, right? You give something away to a qualified charitable organization and you can take a tax deduction for it. If you're in California and you're at the highest tax bracket, you're 37% federal plus your 13.3% state plus some additional bells and whistles in there, Medicare, et cetera. Well, you're looking at 53, 54% tax. So if you give $1 away to your favorite charitable organization, well, you save 53 cents in tax. Well, a lot of people don't like to give $1 away to save 53 cents, even though they do it every day, every year when they say, do you need to buy anything? What capital equipment do you need to buy to make sure you can get some profit off the books? Well, that's spending $1 to save 53 cents or 37 cents if you're in Texas. I don't recommend doing that. So the reason why I say this, David, is because everyone knows that charitable giving can be made profitable. And what do I mean by that? Well, what if you were to buy an asset that you knew that you could give away? Right? There's a charitable organization that was qualified, that had a use for the asset that you're purchasing, but you could purchase that asset at a significant discount to its fair market value. Well, it kind of gets really interesting. So what if you buy something for $1, you give it away to a qualified charitable organization, and you can get a $4 deduction? What if you could do that in the same year? You didn't even have to hold it for a period and hope that it goes up in value because of the structure that we put together. So charitable giving can be made profitable, meaning that a high income earning taxpayer can purchase something for $1, give it away, either keep it because it's worth more than they purchased it for, or give it away to a charitable organization to get a $4 deduction. Now, if you're in California, a $4 deduction at the highest tax bracket saves you over $2 in tax. But if it only costs you $1 to save over $2 in tax, the question I get is, well, how many dollars can I spend for this deduction? And, there's limitations. The federal government's only going to let you do a certain amount of charitable giving of this kind. So it's 30%. But the good news is we can take 30% off the top. So if somebody has a $2 million adjusted gross income, whether they're in Texas or they're in California, they still have a big tax bill on those top bracket dollars. Well, the great news is for 30% of their adjusted gross income, they can take a deduction for this charitable gift. And the great news is the deduction costs them 1/4 of the value. So when you just play out the math, for every $1 they spend on the asset that they purchased that they're going to give away, they're going to get a $4 deduction. And a $4 deduction gives them, even in a state that has no income tax, like Texas or Florida or Nevada or Washington, well, they're still getting 37-cent savings for every $1. And if they only pay 25 cents for it, that's a good deal, right? So they're getting either $1.47 back for every $1 they give away, or $2 if they're in California. So that's a nice little return, and it has nothing to do with market volatility. It's literally just tax savings arbitrage. I was purchasing an asset that's worth this at a significant discount, and I'm turning around and giving it away to a charitable organization and taking the deduction value that's higher than what.
So this could be, so just to put it in some tactical examples, this could be you're buying laptops for a nonprofit that does after school stuff. So I bought 10, 20, 30 laptops at a discount, gave it to them as a gift. Then I have write-offs, assuming it's not exceeding 30% of the income for the year. Or I could buy a building, gift it to a local nonprofit, and again, take that tax credit.
100%, David. The only nuance that maybe some tax professionals are already thinking about if they're listening to this is, well, when you give away a charitable gift of this kind, a tangible kind, well, you can take a fair market value deduction if you've held it for more than a year.
I see.
So the question then becomes, do you want to buy an asset, hold it for more than a year, and then give it away for the deduction? Where we're creating an opportunity where our clients don't have to do that, because there's very well-rooted tax law and court precedent that show that you can acquire an asset inside of an entity that's already held it for a year, and you can legally tack onto their holding period. So what we've done is we've created an opportunity. We have a group that buys resources in bulk, right, at significant discounts, because the group that's selling the asset is looking for capital. They're looking to raise capital, and they have a lot of resources that they can purchase or they can sell at a discount to their normal wholesale. So now we've created an opportunity where we're buying this big amount of asset or resources for a significant discount, and we sell it to our taxpayers for a little bit more. But the good news is it's worth a lot more. And because we've held this asset for more than a year, they can legally tack on to our holding period, meaning they can buy it in November because they know they've got a big tax bill this year and they want to take 30% off the top. They can buy it in November and they can give it away in December, and they can take that fair market value deduction, not their cost basis, because they have legally owned it for more than a year because of the way that they acquired it. So that's really a nuance that I just threw out there because I'm sure that I get that question from tax professionals, but it's very clear. And it's also, interestingly enough, a lot of times the IRS doesn't like it when you do stuff specifically to save tax, right? They hate it when you do things only to save tax. It needs to have some other reason, right? You're doing this and the byproduct is there's a tax benefit, right? But you're doing it for a business efficiency reason. They're okay with that. But in this situation, because it's a charitable gift in nature, all of the tax law and all of the precedent confirms that you can literally buy this for the purpose of giving it away and for the purpose of a tax savings. So there's no issues with I'm doing this just for a tax savings.
Interesting. I love it. All right, let's move on to number 3. I don't know how many we're going to get through because each one of these is so interesting, but let's dive into number 3.
Okay, number 3 is fun. And I put number 2 and 3 together as a 1-2 punch. And these are also good for anyone. It doesn't have to be a business owner that can control their income, but we have a lot of things that we can do for business owners that can control their income. So 2 and 3, let's call it a bird in the hand is 2. And the reason why I call it a bird in the hand is because if you have a high adjusted gross income and you can purchase a gift for $1, you give it away and get a $4 deduction, and you're saving $2 in tax. Well, you have a bird in the hand. For every $1 that you gave away, you get $2. So you have, you have that bird is in your hand. Like you made your money on the tax arbitrage. So option 3 is 2 in the bush. So most of the time I ask people, would you rather have a bird in the hand or 2 in the bush? And obviously different people have different perspectives. Some are like, I'd like the bird in the hand. Maybe I won't ever get the 2 in the bush. Some people are like, I like the 2 in the bush, right? Because there's an upside. So the 2 in the bush is, hey, the government has said, and Tesla and Sunrun and all these big companies, and hey, the new bill that just passed made this phenomenal for the next 10 years. They want the private sector to invest in renewable energy and particularly solar. So option 3 is, well, if you're a high income earner, even if you don't own your business, well, if you're willing to set up an LLC that specific purpose is to acquire solar assets, then we can structure that LLC. For every $1 that you spend to acquire solar assets, you're going to save at least $1 in tax in the very same year. Meaning that the IRS or the federal government just purchased that solar asset for you, right? Because you would have had to send that $1 off to the federal and state tax coffer and never see, well, you see it again in the form of whatever they're spending your tax money on. But what if you said, you know what, I'd rather take that same $1 and fund my solar company and buy a solar asset, and that same $1 gives me $1, not a deduction, it's parity. So every $1 of cash that goes into the solar company to purchase the solar asset is literally a full $1 that they do not have to send to the IRS, meaning that the IRS purchased that solar asset. So why do I call that 2 in the bush? Well, you got your return of capital back on your tax savings. The $1 would have gone to the IRS. Now it goes to your solar company and you own a solar asset. Usually every $1 that you purchase an asset for will give you at least $2, sometimes $3 back in cash flow over the next 25 to 30 years. So you just had the IRS purchase a cash flow producing asset for you, 100%. And now you're going to get $2 or $3 back over time in the form of cash flow from the solar project. So bird in the hand, 2 in the bush. Usually those 2 concepts go together really well because you can only take 30% off the top with the charitable. And you still have a lot of people still have a lot more taxes to pay. So like, well, how much solar should I buy to shift, so now I'm trading my tax dollars for long-term cash flow.
Yeah. And just to put context in it, high income earners, where does that begin?
Okay, so good question, David. Thank you for asking. For the solar play, generally speaking, I want to see a taxpayer having a tax bill of say $160,000 or more. So they're going to cut a check to the IRS for, well, let's say it could be less. It could be around 100,000 or more, but it's hard to get dollar for dollar parity at the lower tax brackets. So when they're pushing out a check to the IRS, federal plus state, and it's 150 or more, we know that we can generally get them dollar for dollar parity if they were to shift into buying solar assets into a properly structured entity that gives them the depreciation against all of their income and gives them a tax credit, and also gives them cash flow. So if they're paying 150 or more in tax, well, yeah, that's about right. 150 or more in tax, the solar is going to be a good fit for them. If they're charitably minded and they want to use this charitable giving made profitable, they generally need to be at $800,000 or more in AGI. So their adjusted gross income is about $800,000 or more. And the reason is because 30% of your AGI is the maximum deduction you can take. And if you're, let's say, $680,000 is about a $200,000 deduction. So you'd be capped at $200,000 deduction. Now you can carry it forward up to 5 years, but most people just want to buy just enough that they need to take 30% off the top. Well, at 680, that's 204 in max. And the minimum required purchase of this asset is 50,000. And you're buying it at a 75% discount. So a $50,000 purchase gives you a $200,000 deduction, meaning that if you don't have $680,000 or more of AGI, then you're going to have to buy more than you really need because you can't take that full deduction in the same year. But the good news is you can carry it forward for up to 5 years. So some people buy more than they need anyways.
Got it. Love it. All right, let's dive into number 4.
All right, number 4, let's switch gears and let's talk about when people sell appreciated assets, right? We're not talking about regular income anymore. We're talking about somebody that might only have 50, 60, 100, $120,000 worth of taxable income every year, right? Which is, they're paying taxes on it, but it's not super painful, depending on the perspective, right? Some people pay $1 and it's painful. Some people pay a lot more and it's not painful. So in this situation, we're looking at anyone that has a highly appreciated asset and they're selling it and they're looking at a long-term capital gains event, right? They're looking at let's just say their appreciation is 6 figures or 7 figures. And now they're looking at, even in Florida or Washington or Texas, they're looking at 20% long-term capital gains plus a 3.8% net investment tax or net income investment tax. So, or NIT. So 23.8% is coming off the table right off the bat. Like they're selling it, all of the profit is going, and because it's a long-term capital gain, they're going to lose 23.8% of their profit right out of the gate. Mm-hmm. Well, what if they realize that, and this doesn't have to be a piece of real estate. This can be stocks that they own that are highly concentrated, not in a qualified account. This can be a percentage of business equity of a business that they own. That's selling, and they just happen to have an event, a taxable event, or it can be real estate. So if they were to know that if they structured their sale correctly prior to selling, as long as the contract isn't inked yet, I always say, hey, is the contract inked yet? No, not yet. Perfect. Make sure they don't sell it to you. So we structure usually a trust entity, a trust structure. Mm-hmm. And now the group that's buying it, and they don't care who they're buying it from, they just want to buy it and receive it, is either a stock sale or an asset sale. Sometimes they want the asset sale because they want to take the depreciation, but that doesn't matter. What matters is if the purchaser is paying a trust, not you, right? Because you've conveyed it into this trust. Now there's no assignment of income. So if there's no assignment of income to me, who held this property or this business interest for X amount of time and it appreciated greatly, and when it was sold, I didn't have assignment of income, meaning I don't have a tax bill. So now the question is, how is the trust taxed? And there's a lot of different ways to go about that. There's trust that defer tax. There's trust that we can eliminate tax. It really just depends on the situation. And I go into more depth with the tax professional and, of course, the client, depending on their situation. But the beautiful news about that, David, is if you're selling a highly appreciated asset, as long as you can structure your sale appropriately prior to that contract being inked, you can legally either defer the tax in perpetuity, or you could essentially eliminate the tax depending on the structure you choose and the method you go about, selling that asset. So that's a fun one.
Yeah. Well, it did dig in the weeds a little bit. If it's sold to the trust, let's say this asset has appreciated, real estate, whatever. You threw an angel check in a company 15 years later, did really well. Then how does that actually trickle down to getting that capital out of the trust and using it if you want to? If you want to take that 7-figure gain and throw it back into more investments, more real estate, and it's in the trust.
Yep, great question.
How do you manage that?
Yeah, so a little bit more granular, but I like it. I like you digging in. You got that. You're wearing the CPA hat today. I like it. So,
I can't help it, and I know we got to get to the fifth one here. So if we want to give a service level answer, and maybe we'll dig into the future. But
I'll dig in a little bit here and be quick about it. So depending on how you're structuring the trust, some trusts are structured in that it's somewhat of an installment note, but you control it. So now the asset that has been sold inside that trust, and you're structuring this note to where you're taking whatever amount of payments that are reasonable, but everything inside that trust, you can reinvest, sell, reinvest, sell, reinvest, sell, and there's no taxable event unless you move money outside of the trust, meaning that you can churn and grow.
Okay.
You can save a ton of transaction tax over a 10, 20, 30, 40 year period because you're not having taxes on those transactions anymore. You just have a little bit of tax on the installments that you're taking out, and you really can control that. On the flip side, there's an elimination opportunity where we can literally take, if it's a bigger sale, we can take the asset or the dollars that were generated from the asset sale, and we can shift them into, and this is kind of higher language, we can shift it into a private placement life insurance policy. And the way that we do so, we've checked all the boxes on tax efficiency. By the time it gets to the PPLI, there's no taxes due. And if you know anything about life insurance, once you get money into a life insurance policy, assuming that there was no taxes due on it going in, or you already paid the tax, then you can invest and reinvest, invest and reinvest, and never pay taxes. And of course, as long as you're taking loans against the policy for whatever you want, there's no tax event. So that's how we can essentially eliminate the tax on the sale of a highly appreciated asset. But those are a little bit bigger sales. It needs to be income of at least, say, 10 million or more. Like the person is going to pay taxes on 10 million or more. This is a solution that might make sense for them. Maybe a little bit less, but.
Love it. Well, let's round into the fifth one here before we wrap up. So what's the fifth and final non-obvious one on your plate?
Okay, fifth and final. I'll go back to the basics. This is easy. This one's for anyone that has their own business, or they're an independent, has their own business, and they're structured as, like, say, an S Corp or an LLC, as a partnership, or or a C Corp. Most people aren't structured as a C Corp, but there's a rule that came about in a little town called Augusta, Georgia, decades ago. And a lot of tax professionals have heard of it already, but maybe they do or they don't implement it. And maybe if they implement it, they don't quite implement it in the way that it can be implemented. But if you know anything about Augusta, Georgia, and you like golf, you know that somebody gets a green jacket every year. And a lot of people converge on Augusta, Georgia every year to watch this exclusive golf event called the Masters. Well, years ago, people that lived around the golf courses in Augusta realized that they could actually rent their homes to individuals or corporations coming in that wanted to basically have a nice space to, bring in and schmooze their clients, et cetera, at the Masters. Well, those same individuals lobbied to Congress and say, hey, this is our personal residence. We don't get any we don't, like an income producing property. We get to take deductions on repairs and, we don't get to take. So what can we do? So they lobbied Congress, and Congress basically said, if you have a primary residence or a secondary residence that's not an income producing property, you have the right to rent that residence to a third party up to a certain number of days per year. And as long as you don't go and you follow all the rules, then the money that you receive for those rentals is not taxable. So I always like to call that the Augusta rule. Mm-hmm. So a lot of small business owners, if they're not having, because now you don't have to rent it to someone else. The next question I get is, well, I don't want a stranger in my home, just to get tax-free income. Well, great. Well, your business is a person. why don't you have meetings in your home for the purpose of the things that you need for your business? And then, of course, diving into that layer by layer, I help that get structured, because that could be a kind of a headache for accountants to put into place. They like the concept, they understand it's been around for a while, but putting it, that's where I come in and I make it turnkey. I'm like, okay, we can easily implement these things for people that need it. So that's a fun one. So you can essentially, take a Augusta, Georgia, the Augusta rule, and rent your primary residence to your business, right? For business purposes or events. And the income that you're receiving is not taxable. And you can get a pretty good amount of income from that, because we're looking at how you do it. So pretty unique thing there.
Interesting. Well, we only touched on 5. It feels like there's probably 500 we can go through. Mark, I really appreciate the time today. If someone wants to reach out, learn more, connect with you, they find these opportunities really interesting, but maybe don't have the time to take them all on, what is the best way for them to connect with you?
Easiest thing for them to do is just go to my website. Thank you, David. Just go to peakprofitsolutions.com. That's PEAK. Profit is singular and solutions is plural. So peakprofitsolutions.com. They can get case studies. They can, schedule a quick complimentary analysis. And usually within 15 to 20 minutes of just a casual phone call, I can identify tax savings and an approximate amount of tax savings. And they can determine, hey, it makes sense for us to engage further. That would be for an end client. And of course, for a CPA or a tax professional, we go through a number of conversations before they get comfortable enough to open the door to their clients, of course.
Yeah, absolutely. And if you couldn't jot down all the notes today, we went through these great 5 non-obvious tax saving strategies. We're going to link everything up at jetpackworkflow.com/blog. That's jetpackworkflow.com/blog. We'll link to the site. We'll link to the strategies. We'll link to everything else Mark mentioned here today. If you enjoyed this interview, please leave a review. It helps us get the word out. And if you really loved it, share it with a fellow firm owner that needed to hear some of this information. Mark, thanks so much for coming on.
David, thank you. It's been a pleasure. Thanks for listening to me.